anyone's joined the call, we're just going to leave it a minute or so, just as people come into the room, just give everyone a bit of time. Then we'll get underway. Okay, let's get going. Can someone just give me a thumbs up that you can see the slides okay? Good stuff. So hello, everyone. Thanks for joining today's webinar. This is going to be on tax efficient investing. This is the second webinar we've done. So the first one focused on all things pensions. If you'd like to revisit that one or see a previous recording, then just let us know. As ever with these presentations, a little bit of housekeeping to start. So usual disclaimer, nothing in this presentation should constitute advice. Advice is very much personal and unique to your circumstances. So if you'd like to follow up on any of the points raised today and how they impact your financial plan, please do get in touch. And in terms of questions, if you've got any questions, then please don't feel like you have to wait to the end. If you enter those into the chat box alongside the webinar, then we can answer those as we go along. And that segues nicely onto the introduction of Kirsten. So some of you may well have met Kirsten before. She joined us in June as a new financial advisor. Kirsten, do you want to just say a few words?
Yeah, hi everyone. I'm Kirsten, and yeah, I was previously advising up in Cambridge and Dorchester before joining the Blinker Group. And yeah, I'm looking forward to hopefully meeting lots of you. I know there's lots of clients on the call, but yeah, I hope you really enjoy this webinar.
Fantastic, thank you very much. And Kirsten is going to be policing the Q&A chat, so she may well be asking a few questions as we go along. So in terms of today's agenda, this is all about tax efficient investing and how best to structure investments to minimize that tax drag. I like to refer to this as sort of location, because we're not going to be talking about stuff like stock picking, fund selection, asset allocation. This is all around where you put those investments. So which wrappers or accounts we use to structure those investments in the most tax efficient way. We're going to look at lots of different accounts. So for example, pensions, ISAs, GIAs, tax advantaged investments, investment bonds, and the relative merits of each. And in numerous occasions, we'll be looking at some case studies to how they work in practice. Oops, jumps ahead a bit of a delay. So this is how we think about tax efficient investing, the champagne supernova. This isn't merely to shoehorn an Oasis reference into the presentation. It's a nod to filling up the most tax efficient account first. So looking at the top layer and then moving on to the next one and so on. So the top tiers are likely represented by pensions and ISAs. They're the sort of low hanging fruit, the most efficient accounts for your investments. The next tier, perhaps a reasonable GIA investment, and we'll come on to what that means a bit later. And then we'll be looking at mortgage repayment, investment bonds, and perhaps some more exotic structures like VCTs, EISs, and so on. The exact prioritization of these is going to differ by individuals. So, for example, some might prefer to invest in ISAs over pensions, given accessibility issues, but we'll come on to that shortly. But as a general rule of thumb, that's the approach. We're going to fill up the most efficient ones first, so looking at pensions and ISAs, then on to the next, and so on and so forth. So if we start with pensions, generally speaking, for the vast majority of people, pensions are the most tax efficient way to build wealth. And that's due to a triple whammy tax benefit. So you're getting tax relief on contributions at your marginal rate of income tax. So for example, the cost of a £10,000 gross pension contribution will be £8,000 for a basic rate taxpayer. They're getting 20% relief. It will be £6,000 for a higher rate taxpayer. They're getting 40% relief. And it'll be £5,500 for an additional rate taxpayer after their 45% tax relief on input. Once inside the pension, there's also no tax to pay on underlying investment income and gains. And then once you've reached the minimum pension age, more on that in a sec, you can draw 25% of your pension completely tax-free, up to a limit of 268,275. That is unless you've got one of the old funky protections. But for most people, it's going to be 268 grand limit on how much you can take tax-free. And then the balance of your pension is going to be taxed at your marginal rate of income tax. And just as a side note here, a lot of people refer to this as EET, which means exempt, taxable. And what we're talking about there is that the initial input is exempt, or you're getting tax relief on that contribution. The gains within the pension are exempt, tax-free gains, but you pay tax on the way out. So that's where you get the EET from, and we'll come back to that when we're talking about ISAs. Currently, the tax benefits of pension contribution are in fact greater still because the money is currently outside of your estate for inheritance tax as well. But as many of you will have read in recent blogs, that's all due to change from April 2027. As per the new rules announced in the last autumn statement, pensions are going to form part of the estate for IHT from April 2027. So that sort of fourth benefit of pension contribution, or fourth tax benefit, is due to expire in a year and a half or so. So the tax benefits of pension savings are still exceptional. And one thing I'm seeing quite a lot recently is certainly younger clients are now questioning whether it still makes sense to save into a pension, given the rule changes, but more typically given potential rule changes to come. I feel like there's certainly a lot of negative sentiment around what the government are going to do with pensions, people saying it's an easy way for the government to raise a bit of revenue. I think that's a valid concern, but the government, it's a bit of a double-edged sword in that the government need a very, very healthy private pension sector to reduce reliance on the state further down the road. So we still feel that pensions are very valuable, and as I said at the start of this slide, generally the most tax-efficient way to build wealth for the future. All that being said, we need to be mindful of the big disadvantage of pension saving, which is one of liquidity, in that pensions can only be accessed from the minimum pension age. Now that's currently 55, set to rise to 57 by 2028. And generally speaking, the idea is that that minimum pension age, i.e. the minimum age at which you can access a private pension, will generally be 10 years below the state pension age. So that should likely continue to climb over time. But that is the trade-off. You've got tax efficiency versus accessibility. In terms of how much you can pay into your pension, there are effectively two limits when it comes to personal pension contributions. So you can contribute the lower of your annual allowance, and the standard allowance is set at 60 grand a year, but this tapers down for higher earners. So those with so-called adjusted income, which is all of your taxable income plus any employer pension contributions, where this rises above 260k, the annual allowance is then reduced at 50p in the pound, down to a minimum of 10 grand per tax year. So as an example, let's say you've got someone with total taxable income, which is not just their employment income, but any interest income, any rent, etc. Let's say they've got total taxable income of 280 grand in the tax year, and that they're also receiving 20 grand of employer contributions into their workplace pension. That would imply adjusted income of 300k. That exceeds 260k by 40, 50p in the pound taper. So their annual allowance, easy for me to say, would be reduced by 20 grand in that instance. So they'd be able to contribute 40k per their annual allowance. But it's also important to note that you can carry forward any unused allowance from the previous 3 tax years. But a caveat to that is that you must have been a member of a registered UK pension during those years, even if you weren't contributing. So that is the annual allowance. The second limit is certainly for personal contributions. It's limited to what's known as relevant earnings. And this is generally your work-related income. You can make a personal contribution of up to 100% of your relevant earnings and still receive tax relief on that contribution. So say, for example, you've got a load of available allowance, so you've got to carry forward from previous tax years, but you're only earning, say, 60 grand, then you'd be capped at contributing no more than 60k. And I think a lot of people miss that. They assume that you can just contribute all of your annual allowance, but your tax relief on a personal contribution will be limited to your relevant earnings, which is generally work-related income. One final thing to note on this slide is that for employer contributions, they work slightly differently. You've still got that annual allowance limit, but the income restriction doesn't apply. And that's relevant because most company directors will remunerate themselves in dividends and then contribute to the pension as an employer contribution. And there's a second slightly woolly limit here, which is called the wholly and exclusively test, which essentially means that the contribution must be reasonable for the work permitted. So a classic example would be you've got a limited company, you've got Mr. and Mrs. as limited company directors. For directors, there's generally fine to contribute all the way up to the allowance. But let's say you had a child as an employee or a spouse as an employee that wasn't a director, it would be pretty hard to justify say a 60 grand contribution for them, assuming that they're performing relatively modest administrative work, say, and then have another full-time employee who's receiving, say, 500 quid a month. That would fall foul of this wholly and exclusively test. The final thing to say here is that clearly annual allowance calculations are pretty complicated, certainly when it comes to carry forward, the calculation of adjusted income, the calculation of threshold income. But obviously that's a key area where we can assist in doing those calculations. And then the final slide on pensions, and this is something that comes up a lot, and this is where we fall into that 60% marginal tax trap. And this is a real key area of advice for us. So this occurs where total taxable income crosses the 100K threshold, resulting in 60% effective income tax. And that's the result of the higher rate, which is 40%, but also a further 20% because your tax-free personal allowance starts to taper once you cross that 100K threshold. So the net result is that you start to incur 60% income tax. But for parents of small children, the impact is even more severe because there is a cliff edge loss of childcare benefits above that 100K threshold. So you're no longer entitled to free childcare hours, which as of next month could be as much as 30 hours per week for children from 9 months old. And you also lose your tax-free childcare as well, which can be worth up to an extra £2,000 in government bonuses per tax year. The net effect is that we see marginal tax rates of well over 100% here in terms of someone being pushed above 100K total income actually being worse off as a result. But the good news is that this can easily be rectified by simply contributing more money to your pension. And I think this is quite poorly reported on in financial media. Everyone focuses on those savage tax rates, which is fair, but actually the solution is relatively straightforward, which is you make a pension contribution equivalent to the excess, bring you below the 100K threshold, and then the tax benefits are pretty phenomenal in that world. And just to sort of put some numbers on that, running a very simple example, let's say Michael, in this instance, has just had a pay rise from £99,999 a year to 115K a year, and that he's got 2 children, aged 1 and 3, both at nursery 36 hours a week. So that's 4 days, pretty much full time, and a cost of £8 per hour, which is pretty reasonable. Then Michael's 15,000 pay rise will increase his take-home pay after income tax by just £5,700 after income tax and national insurance. So he's getting hit for an effective 62% tax. But him also going over that 100K threshold for those childcare benefits is going to cost him an extra, I work it out as about 17.5 grand in additional childcare costs due to loss of entitlement. So that implies that he's actually worse off to the tune of almost £1 grand a month as a result of his 15 grand pay rise, which is absurd, a broken tax system in that instance. However, the solution is pretty simple, that Michael would contribute an extra 15 grand gross to his pension. He would get 62% income tax relief. He'd retain his entitlement to all of those those childcare benefits, and implies well over 100% tax relief, i.e. he's got an extra 15 grand in his pension and he's got more money in his back pocket as a result of that pension contribution. I think what I would say is that if anyone finds himself in this trap, so to speak, again, get in touch. We can run the numbers for you, advise you accordingly. And the common mistake that I see time and time again is people leaving this too late and doing it sort of late in the tax year. But for the childcare perspective, you have to self-declare that you're going to be entitled for those childcare benefits at the start of the year. So this needs to be done well in advance. You can't subsequently reclaim those childcare costs retrospectively. It has to be done in advance. So that's it on pensions. The next one, and the next like top tier in the champagne supernova, so to speak, is ISAs. And many, if not all of you, will be very familiar with these, but a quick reminder of the rules. So you can save up to 20 grand per tax year into your ISAs, and that's applicable across all ISAs, so cash, stocks and shares, etc. It's not per ISA type. So for example, if you've got 10 grand in a cash ISA, or you've invested 10 grand in a cash ISA that tax year, you could only do up to 10 grand in stocks and shares ISA in the same one. And then referring back to that, so if you recall pensions, they were EET, exempt taxable. With ISAs, it's TEE, in that you're contributing from net money, as in money that you've already paid tax on, but subsequently any investment income or gains are completely tax-free, exempt, and there's no tax to pay on the way out either. So you're contributing out of net income, but you're getting tax-free growth, and you're getting flexible access without any tax to pay on exit. So ISA is clearly very tax efficient, and a major benefit versus pension savings, say, is that ongoing access. So for clients where liquidity is a key consideration, then they might favor ISAs for some or all of the money. Just a side note on this slide. So one common pitfall that we see is clients holding cash in ISA and investments outside of ISA wrapper. We'd argue that that's the wrong way around. You want the highest performing asset within the tax-free ISA wrapper to benefit or to maximize the benefit of that tax-free growth. Obviously, there's no guarantees on that, but historically, at least, investments have far outperformed cash. So using your ISA allowance for an investment ISA rather than cash ISA, we would argue is the right approach. Lifetime ISAs. So this is a special ISA type that we would argue is a potential no-brainer for some. The rules are a bit convoluted, and there's always pressure on these to be changed, but they haven't been changed for many, many years. But just running through these quickly. So you can only open a lifetime ISA between ages 18 and 40. For anyone coming up to that age 40 point in time, and even if you haven't got any available capital right now, it might be worth just opening a lifetime ISA to beat that deadline, to enable you to then contribute for a further 10 years beyond. So you can contribute up to 4 grand per tax year, and that forms part of your 20 grand allowance. And in contributing to a lifetime ISA, you get a 25% government bonus. You effectively get free money up to the limit of £1,000 per tax year if you do the maximum 4K. Once it's open, as I say, you can carry on contributing up to age 50. And in terms of withdrawals, you can use the funds either to purchase a first house up to a price tag of 450k. And it's worth noting that you can combine your LISA savings with someone else. So, for example, two spouses both have LISAs, they can pool their LISAs together to buy that first property. But lifetime ISAs money can also be used in retirement aged 60 plus. If you withdraw money for any other reason, so say you're going to buy a house of £451,000 and you just want to get the money out, or you need to access it earlier than age 60, then you will incur a 25% charge on withdrawal, which effectively claws back the government bonus, but also slaps you with a 6.25% penalty for good measure. So it's really important at the outset to be pretty focused on what you're going to use the LISA for. Is it going to be for a first property purchase? And if so, is that property purchase going to be within 450k? Now, once upon a time when these were introduced in 2017, that was generally the case for the vast majority. But it's important to note that house price limit hasn't been changed at all since then. If it had kept pace with house price inflation, it would now be closer to 550k. And that's becoming a bit of a drawback now. I certainly see that for younger clients who are like, do you know what, in London, 450 grand actually doesn't get you too much as a first property purchase. So that's becoming a consideration. But where I think LISAs are a potential no-brainer is if that first property purchase is going to be within 450. But also for those who are higher earners, potentially locked out of contributing a material amount to their pensions due to the aforementioned tapered allowance, lifetime ISAs contributed to over a long time can add a really attractive additional retirement pot. You know, if you're putting 4 grand or 8 grand per couple into a LISA each year over 20 years, say, getting the government bonus, getting the investment returns compounded over time as well, you could be looking at a really nice additional retirement pot. And going back to that previous EET versus TEE for pensions and ISAs or standard ISAs, LISAs are actually exempt in that you're getting a government bonus on the way in, which is equivalent to basic rate tax relief. You're getting tax-free growth along the road, and then assuming that you access the LISA post age 60, it's also exempt from tax at that point as well. So really, really tax efficient lifetime ISAs. So we filled up the top couple of tiers on our champagne fountain. The question that we often get asked is what next? So one of the another attractive account is just a simple general investment account, the GIA. Not the sexiest of names, and this is often labeled differently depending on the provider. So, for example, some will call this a trading account. I think Hargreaves Lansdown call theirs a fund and share account. But these are all the same things, which is a GIA. And this will look and work in a near identical manner to a stocks and shares ISA. The only difference is the tax treatment of income and gains. That is any investment income and any realized, it's important to know, realized, not unrealized, realized capital gains within the GIA are subject to tax. But what many people miss is that these are still pretty tax efficient, certainly when they're structured in a certain way. And that's because individuals have various tax-free allowances to set against the investment income, specifically a 500 tax-free dividend allowance, and for certain taxpayers, a personal savings allowance to set against interest income. And in terms of capital gains, then every individual has a 3 grand tax-free capital gains tax annual exempt amount or annual allowance. So we've got those allowances. But also the other factor with GIAs that I think is often underappreciated is that the taxation on dividends and realized gains, certainly for basic rate taxpayers, are pretty low. So basic rate taxpayers will pay just 8.75% tax on dividend income and just 18% on realized capital gains. Now, those rates aren't quite as good as they were a few years ago. The CGT has gone from 10 to 18% in the last year. But still relatively low. And what we can do is often essentially convert someone to a basic rate taxpayer by combining a GIA with pension contribution. So I think that's really common and good planning. And I've got a case study on the next slide to demonstrate that. So here's an example. Here's the setup. So you've got a couple, clients A and B. Client A is a mega earner, so earning £500,000 per year. Clearly, additional rate taxpayer, very limited in how much they can contribute to a pension. And client B, still a good earner, high rate taxpayer, earning 60k a year. What we could do in this instance is to make the maximum pension contribution into client B's pension. So for client B, that would be 100% of their relevant earnings, so 60 grand. And what that effectively does is bring their adjusted net income down to zero and reinstates their full basic rate tax band of just over 50 grand. And now, assuming that we've maximized their ISAs, which would be a no-brainer, and we've made a sizable contribution to B's pension, we've presumably maxed out A's pension with 10 grand as well, we could then look at building a sizable GIA portfolio held solely in client B's name. And to demonstrate the tax treatment, let's say over the time, either with surplus income or some lump sum payment, say gift or bonus, house sale, whatever that might be, let's say clients A and B have built a £1 million GIA portfolio structured solely in B's name. That would generate dividend income of about 20 grand a year, which is taxed at 8.75% only. And bear in mind, we only pay capital gains tax on realized capital gains, which we can control. So let's say the portfolio is at 10% one year. We don't need to sell the whole thing. We could sell just enough to effectively control the capital gains tax. And in this instance, we would look to ideally realize about 30 grand of capital gains, such that that also falls within the remaining basic rate tax band. So the long story short, on a £1 million GIA portfolio, and let's assume a 5% return across dividends and gains, that would imply a nominal return of 50 grand and a tax bill of just 6,600. So in this instance, they'd be looking at an effective tax on growth of just 13%. And that just highlights that GIAs structured in the right way and potentially blended with pension contribution can still be pretty tax efficient. So once we've built up a GIA to a critical value, that critical value very much would depend on the individual circumstances and wider income position. We might then look at alternatives. So the sort of bottom layer of the champagne fountain, if you like. And the three most common will be some blend of investment bonds, which we'll cover first, private company investments or venture capital investments via VCTs and EISs, cover second. And then we'll quickly look at mortgage overpayment as well. But first and foremost, what are investment bonds? So these are not bonds in the traditional sense. They're not government or corporate bonds, which are IOUs effectively. Rather, they are investment accounts that are issued and managed by insurance companies. Because they're issued by insurance companies, they typically carry a token amount of life insurance, normally 0.1% of the investment amount. But in doing so, that qualifies them for certain tax advantages, which we'll cover on the next slide. There are two broad types. We've got onshore bonds, which are issued by UK life companies, generally incur 20% tax on all underlying profits, which is non-redeemable but paid out with a tax credit. And offshore bonds are issued by life insurance companies in foreign jurisdictions, but we're talking about Isle of Man or Ireland. We're not talking Cayman Islands or Panama or anything like that. We tend to operate in the offshore bond market, tends to offer a bit more flexibility around taxation because there is 0% tax during the life of the bond rather than that 20%, but we'll come back to that in a sec. So how do they work? How are they taxed? As life insurance products, investment bonds benefit from several tax advantages. First and foremost, for offshore bonds, there is no immediate tax to pay on underlying investment profits. So say, for example, you seeded a new offshore bond with £500,000 in year one. That was invested in a multi-asset fund. And as a side note, these can invest in all of the usual funds, multi-asset funds, Vanguard, BlackRock, so on and so forth. But let's say you invest £500,000 in year one. First year, that returns 5%, so 25 grand in nominal terms. Whilst that money stays within the bond, there's no immediate tax to pay on it. So there's no immediate tax to pay on that 25 grand growth. There's no need to declare it on your tax return. And this is what's known as the gross roll-up on investment bonds. Note for onshore bonds, you'd be paying an effective 20% tax on those profits. And this is simply collected via the underlying fund itself. But then when you subsequently come to cash in the bond, there'll be a 20% tax credit. So you'll only owe more if you fall into the high or additional rate brackets. The second point on this slide is the 5% tax deferred withdrawals. And what that means is that each and every year, you can withdraw up to 5% of the original investment without incurring any immediate tax charge. It's also important to note that any unused withdrawal allowance will roll forward to the next year. So returning to that previous example, if you'd invested £500,000 in year one, you can withdraw 5%, so 25 grand a year, up to £500,000 cumulatively over 20 years without any immediate charge. Just two follow-on points here. We think this withdrawal mechanism is a great way of funding school fees. So, for example, let's say someone set aside 250 grand or 300 grand to fund the entirety of their kids' private school fees via an offshore bond. They could then gradually withdraw funds using the available allowance to meet those annual school fees, all the while not incurring a hefty tax charge that is instead deferred. But the second point is that on that deferral, it's really important to emphasize that these withdrawals, the 5% tax deferred withdrawals, they're deferred, not exempt from tax. And I think there's a lot of misleading financial marketing on that front, which almost implies that these are tax-free, but they're not. It's simply pushing the can down the road on the taxation standpoint. But the play is that you want to defer tax from a period in life where you are a higher or additional rate taxpayer to one where you have hopefully a gap in earnings altogether. So say between retirement and commencement of state pensions, or where you're a basic rate taxpayer. That is ultimately the play of investment bonds. It's that tax deferral, pushing the taxation out from a period as higher or additional rate to one as a basic or non-taxpayer. The next funky part of investment bonds is that they are split into lots of tiny little segments. So our preferred provider defaults to 1,000 underlying sub-policies or segments. And this offers excellent tax planning opportunities, as you can effectively control your tax liability here by surrendering just enough policies such that the resulting profits on those segment surrenders fall just within your basic rate tax band, say, or better still, within your tax-free allowances. And that's when you start to incur taxation on bonds, is when you start to surrender policies. And then that's also an important point to note, is that when you do surrender investment bond segments, all of the profits to date are calculated on the segments and then taxed as savings income. And then the final point to note here is that with investment bonds, you've got this function to assign underlying sub-policies or segments, and that can be done without tax and without charge. And what this effectively does is pushes the point of taxation onto the recipient of assignment, the assignee. And going back to that school fee point made earlier, if you consider this example, so let's say Kate invests 300 grand into an offshore bond back in 2007 to fund the private school fees of her child. To date, she's withdrawn 200 grand using the annual tax deferred withdrawal allowances. And the bond today is worth 400 grand, as the investment growth has more than outpaced the withdrawals so far. Of course, that's not guaranteed. Now that the child, Alex, is of majority age, the policyholder, Kate, could now start to assign some or all of the underlying sub-policies from her name into Alex, who could then surrender in her own name. And this can be really effective, say, to use the residual proceeds either for university fees, for a house deposit, car purchase, whatever that might be, because the likelihood is that the now majority child is probably going to be a non-taxpayer if they're at university, or at the very least a basic rate taxpayer. So that's a great way of being able to use the funds initially to fund private school, and then subsequently for a different use further down the line, and achieve a really tax efficient exit, probably getting the money out at a mix of 0% and 20%. Now, obviously, as I've demonstrated, investment bond taxation is very, very complicated. We've written a couple of blogs on this, but in truth, I think we would be able to do a full webinar just on this topic alone, and that's certainly something that we're planning in the pipeline. I think the key point to note is that this is becoming increasingly popular because two things. One, capital gains rules have been tightened, so we've seen a reduction in the annual exempt allowance now to 3 grand, and also an increase in CGT rates. But also within the offshore bond market itself, there's been a sort of explosion of competition in that world. So it used to be just two providers dominating the market and charging quite absurd amounts. Thankfully, that's now changed. It's much more competitive. So product charges have dropped pretty much in line with other account types. So investment bonds are now a much more attractive proposition. And again, this is all about tax deferral. So pushing tax out from a period where you are higher or additional rate to one as a non or basic rate taxpayer. The second sort of alternative, if you like, is to consider certain venture capital investments. And two main types here, which are going to be VCTs and EISs, so venture capital trusts and enterprise investment scheme qualifying shares. Very important to note that these are classed as very high risk, and that's due to the nature of the underlying businesses, because these invest in typically pretty young, small, very high growth entrepreneurial businesses. They are illiquid. Normally you can't get your money out for several years, and they have limited product diversification, and they're typically reliant on a few key personnel. So these aren't for the faint-hearted. These are high up on the risk scale. As such, VCTs and EISs are only suitable for certain people in certain instances, and even then, for a relatively modest proportion of investable assets. We typically advise no more than a 10% weighting. But just drilling down into how they both work. So venture capital trust, this will be a single fund or a single investment trust, which then holds normally about 50 plus underlying VCT qualifying businesses. To encourage investment in such schemes, the government offers some significant tax advantages, specifically 30% upfront tax relief, although that's subject to a 5-year minimum holding period, as in if you sell it within 5 years, the government will come knocking for their 30% relief back. And during the life of the VCT, you're getting tax-free dividends and tax-free capital gains. Now, counterintuitively, tax-free dividends are typically the main source of return for VCTs, and that's not the underlying companies paying dividends, given that they are small and high growth. Rather, it is the VCT exiting some of those underlying holdings. So let's say the VCT holds 50 companies, for example, and it sells one of them to big US tech company. That will raise a load of cash, and then the VCT will subsequently pay that out as a dividend, which is then tax-free. EISs are similar, but these are single company investments rather than portfolios. They're typically earlier stage versus VCT, as in the qualifying criteria is slightly different. Also getting 30% income tax relief. It's a slightly shorter 3-year minimum holding period, but that's a sort of irrelevance because you'll have no control over the exit. You'll just get some money if/when the company is sold. Loss relief available against income or capital gains tax. You're also getting tax-free capital gains, and EISs are typically business relief qualified, which means that they're going to be exempt from inheritance tax. So to sum up on the difference between the two, EISs are generally smaller and therefore a little bit riskier, but as a result carry slightly better tax advantages. We typically operate in the VCT world, primarily because the greater diversification is attractive in our view, and slightly lower risk, albeit this is, as I say, a very high risk investment space. And just expanding on the VCT side of things, so we think one area where VCTs are perhaps underappreciated is when you get into a VCT recycling strategy. And this is particularly relevant for young, high earners when they've got scope to hold a VCT for 5+ years and then enter this recycling strategy, because what they can then do is sell it back to the VCT manager. That's normally at a 5 to 10% discount. Then they can reinvest the proceeds into another VCT and get a second round of tax relief. And I just point you to a blog that we wrote recently about this, which was essentially critiquing a recent FT article that was all about the poor returns of VCTs over the last decade or so. However, the article focused solely on pretty much the worst performing VCT over that period, and also just failed to acknowledge the additional return potential if you have the recycling strategy in place, and therefore have scope to benefit from second, third, or even a fourth round of recycling, and therefore 3 to 4 rounds of additional 30% tax relief on repeat investment. But just to close on the VCTs and EISs, like I say, these aren't suitable for everyone, but for certain clients who've maxed out pensions, maxed out ISAs, potentially paid off a bit of mortgage debt, which we'll come on to in a sec, potentially built up a reasonable GIA investment, this could be a good addition for a modest portion of additional investable assets to benefit from the high growth potential of some of the underlying businesses, but also those tax benefits, including the recycling strategy. And then the final option to note is that paying down a bit of mortgage debt we think is often a good strategy and one that is often overlooked. And the way to think about this is whatever the interest rate is on the debt, that is effectively a risk-free, tax-free rate of return to be had by overpaying your mortgage or paying down a sizable sum at the next fixing date. The drawback with mortgage repayment is that is liquidity, in that you're effectively increasing your equity in the property and therefore tying up capital in the property. But nevertheless, let's say someone's got a sizable cash pot or sizable income surplus, directed a portion of that to mortgage repayment and therefore getting a risk-free, tax-free return of around 4 to 5% currently, we think makes sense for a lot of people for a portion of that money. As always, it's unlikely to be an all or nothing. This is going to be a blended strategy with ISAs, pensions, etc. But we think it is worth consideration. And that's it from me. Kirsten, over to you for any questions that may or may not have come in.
Yeah, George, that was great. Thanks so much. There is still lots of time to put your questions in the chat, and thank you to everyone who's put some questions in so far. So feel free to add if you like, but I'm going to get started on what we've got so far. So I've got a couple around ISAs, George. So I'm going to do those first. So the first question: does a LISA, a lifetime ISA, count towards your ISA allowance?
Yes. Yeah. So if you put £4,000 into your LISA, which is the maximum amount, that uses £4,000 of your 20,000 allowance. So you've now got 16K left over to put into other versions of ISA. I think one important point to note is that the £1,000 government bonus does not count. So it would be the amount that you've actually contributed. So in that instance, £4,000 becomes £5,000 with the government top up, but would only use up £4,000 of your 20K allowance.
Brilliant. Okay, another one around ISAs. So are ISA allowances due to change? I know there's been a lot of talk about this recently. What are your thoughts?
Oh, crystal ball into the autumn statement. So I think it's been pretty much ruled out. So the worst, we certainly had quite a few clients inquiring about stocks and share ISA allowances, but my understanding was that was never really on the table. The focus was on cash ISAs. So there were some rumors that the cash ISA allowance would be reduced from 20K to perhaps 10K, whereas the stocks and shares ISA allowance would be retained, as in you would be able to put the full 20K into a stocks and shares ISA. But I think that's now been ruled out anyway. To be honest, I can sort of see the merit of limiting the cash ISA allowance because encouraging more people in the country to invest, I think, would be a good thing. That being said, is reducing the cash ISA allowance a good way of facilitating that? And I would argue probably not, because I think what would happen is people would just save outside. People still stay in cash, but outside of an ISA allowance.
Okay, brilliant. Another one's come in about lifetime ISAs. So can the money be used without penalty for part of the property price, i.e. up to 450,000?
You were cutting out a little bit there, but I think the question was, can the lifetime ISA be used for part of the property purchase up to 450K? So no, it's based on the full property purchase. So you could, my understanding at least is that you can split your lifetime ISA with someone else, but it's based on the full value of the property. So what you can't do, say for example, you're buying a property worth 800,000 with someone else, and you will own half of the property. My understanding is that that would break the LISA rules, as in it's based on the full property value, even if your stake is less than the 450K. So it has to be the full property value that's within 450,000 is my understanding of it, but I'd need to check that actually.
Yeah. I think that's, I would tend to agree with you actually. I think those are the rules, but yeah, we can definitely double check on that. Okay, let's move on to pensions. So pensions. So We know that the pension age will change as time goes on. Has there been any talk? We're still on lifetime ISAs. Has there been any talk of increasing the lifetime ISA age along with the pension age?
Not as far as I've not that I've heard. I think there's a lot of pressure on reform of lifetime ISAs. Certainly around the purchase price of a property, because 450 grand is starting to be a restriction. More and more people are pushing up against that limit, certainly in London. So there's definitely pressure on the government to increase that limit. In terms of the age, I've not heard anything on that side of things. But to be honest, given the way that these things change, it wouldn't surprise me at all to see the whole ISA rules overhauled at some point in time. I think it's always difficult to change things retrospectively. So I still think there's always going to be, while they're in existence, it's a good strategy for many to be contributing to a lifetime ISA. But I know AJ Bell, for example, are lobbying the government to just have a single ISA structure where you can then hold cash investments, that you could potentially factor in a bonus for house purchase within that as well, just to simplify the whole thing. Because even beyond cash ISAs, stocks and shares ISAs, and lifetime ISAs, we've also got junior ISAs. We've also got innovative finance ISAs, which I've never known anyone use. So we've still got some people with old Help to Buy ISAs as well. So it's complicated, and it certainly seems ripe for overhaul at some point in time. But that's a very long-winded answer to your question, which is I've not heard any talk about a change to the age at which you can access it.
Okay, fab. So we've still got a little bit of time, so I'm going to carry on. Let's chat about another political one. Will Rachel? Oh, it's not political. So I beg your pardon. Will Rachel from accounts restrict pension tax-free cash in the autumn?
Yeah, political. So that one very, very often does the rounds. So we pretty much hear that rumor ahead of every spring budget and autumn statement. So that is that we could see potentially a reduction in the upper limit on tax-free cash, which currently stands at 268,275. And there's long been rumors that that could be reduced to, say, 150 grand or even 100 grand, which would be a material revenue raiser. But personally, I don't see it. I may well be eating my hat in 3 months' time. But I think what often gets missed is that, as I said in the presentation, we really need an attractive pension, an attractive private pension market in the country, because the alternative is people don't save enough for retirement, and therefore increases reliance on the state further down the line. So I personally think that the pension tax benefits will remain pretty attractive. All that being said, there's an effective cut each and every year on the tax-free cash because it's perpetually frozen. I mean, I know that the headlines are saying that the freezers are going to thaw, so to speak, in 2028. But I think that's an easy win for the government, is just to extend the freezing of allowances, which not only is the income tax bands, but potentially that tax-free cash amount. So I think we're more likely to see that just kept where it is for even longer, which is essentially a cut in disguise. But I think fears of a reduction in tax-free cash are perhaps a little bit overdone. And actually what you saw last time around when that was rumoured was a lot of people taking out their maximum tax-free cash, which ultimately was not a good thing to do.
Okay, and how are we doing for time? 20 past, let's keep going. So another one about offshore bonds. So what happens to offshore bonds if I move abroad?
Good question. So that potentially opens up a really tax efficient exit, depending on the jurisdiction to which you go to. But we often see that, so it could be really good planning. So say, as an example, you're a higher or additional rate taxpayer in the UK, and you've got plans to move abroad. And we are seeing that, not loads, but seen a couple of clients this year move to Dubai, as an example. And what could be really effective planning would be to open an offshore bond whilst you're a UK resident taxpayer, fund it, and then if you were to move to an overseas jurisdiction where they don't or where you don't incur tax on subsequent extraction from the bond, then there could be a highly efficient way to draw money from the bonds. As in, let's say you move to jurisdiction A, where you don't owe any income tax or capital gains tax on bond profits, then you could potentially get the money out at 0% tax. I've certainly seen that, but it's very much dependent on which jurisdiction you go to. You know, US, for example, would be very tax heavy, whereas certain parts of the world will potentially let you take the money out tax free. I'd always say it's worth, if that's something that is relevant, then do let us know. It's not an area that we operate in. You know, we are UK tax planners, but there are certain companies that operate across those different jurisdictions, and we could put you in touch with one of those.
Okay, brilliant. So I think this is the last question, and then we should finish 5 minutes early. So why would you opt for VCTs over EIS?
Oh, great question. Yeah, and optically, the tax benefits of EISs are superior because you're getting that loss relief, also potential inheritance tax relief. And if it qualifies as an SEIS, so this wasn't in the presentation, but you could actually get 50% income tax relief rather than 30% relief at outset. So the tax benefits of EIS investing are superior. The reason we tend to operate in VCTs is one of diversification and therefore risk. That most of the EIS managers that we see, they would typically spread investments between 5 to 8 underlying companies that are typically very early stage, even seed stage, whereas VCTs are typically slightly later stage, so investing in more established businesses, but also a much larger portfolio size. So typically at least 50 companies, but we invest in some VCTs that are more like 80 to 100. And even though the tax benefits aren't quite as good, even though the return potential is probably not quite as good because you're investing at later stage, we'd argue that the downside protection is far greater, as in much better level of diversification, and so much lower risk, albeit, as I said before, it's still a high risk part of the investment spectrum. So the answer is much more diversification and therefore lower risk in what is a high risk space.
Okay, I think that wraps up the questions. So if anyone has any more questions, please do just ping us an email. All of our details are on the screen now, so you can take a little screenshot or something like that. And yeah, I think it's back over to you, George.
Yeah, thank you very much. Thanks, Kirsten. Thanks, everyone, for listening. Hope you found that relevant. As Kirsten said, please feel free to get in touch if you want to discuss any of the points in more detail. And look out for our next webinar, which will be in the next 3 months or so, and details will be announced very soon. Thanks all.
Thank you. Bye.